Hello, everyone, and welcome to a special President's Day version of Macro Matters. We are here, as I know it's a holiday in the markets, but we're here still to talk about the macro that matters. And joining me today is my colleague, as always, Tony Zhang. Tony, uh,
Yes,
welcome back from St. Louis and the CFA Research Challenge. Glad to have you back with us.
yes, thank God. It's quite a very enjoyable experience and also a journey anyway. But we can actually start to talk about the market after all of these things are finished which so far has turned out to be very exciting, especially in the past 1 week or two. There are a lot of information that we can actually discuss and share with the audience today.
There is a lot going on for sure, and I think to me one of the things we were talking about ahead of time is the Fed. The Fed is back in play, right? The Fed was kind of largely out of play, and that's what where the market turned, I guess, like the end of October of last year, and that was the big rally, right? That was the rally of market pricing in that the Fed was not moving off a pause onto rate cuts, and the multiples expanding, and stocks were going to new highs. And all of a sudden, in the last couple of weeks, we've gotten a lot of economic data, inflation data from the CPI and PPI, as well as jobs data. And all of it seems to suggest that maybe, just maybe, the Fed is not finished, or maybe just maybe the Fed's not going to cut the way everyone thought they were going to cut. And then Jay Powell was on 60 Minutes telling us the same thing. And so the Fed is kind of back in play, and that should matter for investors. So maybe those are some of the things we want to look into. And as we both always talk about, when we're in these different kind of phases of the economy and the markets in terms of growth and inflation, what does that mean for the different investment styles that people should care about, right? That because I think oftentimes we focus on the headline index and not as much about what's going on beneath the surface, and that's usually where the interesting things are going on. That's where the active managers try to make their money, not so much in just saying whether or not the market's going to go higher or lower. So those are some interesting things to kind of think about. So where do you think we should start today, Tony? What do you think?
We can maybe start to talk about the the data that you did
Sure.
actually to talk about the CPI and PPI. What's your take on that?
Well, I think I think the take on it is, and this is something I put out a couple of weeks ago. I teach my portfolio management class, and our students forecast the economy, and it's the first time they're ever building a model. But we talk through what these types of variables they should look at to forecast, et cetera. And so I build an index that basically uses the five variables that are most common, right? Every semester, I'll get about 10 models, and I've been doing it now for about whatever it is, 10 semesters. So I get enough data points to see what are the ones that seem to percolate the most. And I look at these a couple weeks ago, and these variables are things like PPI, financial conditions, commodity prices, money supply, and inflation expectations are the five things that kind of pop up the most as being significant in most models. Um, if I just build a simple index with those, that tells me that inflation, that tells me that inflation is going to stabilize, if not move higher, right? Some of those one or two maybe are flat to pointing lower. Most of those are kind of pointing higher at this point, and that tells me that we haven't beaten inflation, right? The market, I think, is
Right.
pricing in inflation gently moving back to the 2% target, and I just don't know how close that's going to be to happening. And so I looked at that. So I was anticipating CPI to come in higher than expected based on that, and it did. And then PPI kind of validated that and came in and was much higher than expected. And then something else I'm looking at is this idea that we've got a lot of fiscal stimulus still in the pipeline, and fiscal stimulus impacts the economy with about a year lag. And this time around, this one thing that's very, very different about the fiscal stimulus this time around is that it's pro-cyclical, right? Usually we
All right.
see the government running big deficits when the economy is shrinking. The economy is growing still, and the government's running big deficits. And I think when I look at that, and I look at the level of GDP plus the percent of GDP in fiscal stimulus are at levels we really haven't seen since the 1980s. And so that's another one that kind of points to me that suggests that inflation might still be a problem. And I think while the market has started to price out many of the cuts that it had, I think there's still more cuts to be priced out. So maybe I wanted to show you a few things on Bloomberg, and we could
Sure,
talk through
sure.
them. we'll start right there with the expectations for what the market is pricing in. And we'll start here with um, with the screen on. This is what the market's pricing in. You can see about 3.5 cuts by December of this year. You can see essentially at this point, maybe only 10% odds of a cut in March. And most people are saying that the cut's probably going to come around somewhere around June. Now, if I look back, I can change this date back to February 1st. We had people were still pricing in about 38% odds of a cut in March, and we had almost 6 cuts priced in December. And so
Mhm.
quite a few cuts have been priced out in that period of time. Um, and if you look at it, and I'm going to put another page up here. Sorry. Fed dot plot, right?
Mhm.
And then
Correct.
this is another one. We can see the green line is the Fed dot plot, where the Feds told us in December what they think is going to happen for rate cuts. The blue line is where the market was in December, and then that white line right here is where the market is now. So you can see the market has moved largely back to where the Fed told us it was going to be in December. And so maybe we're finished pricing out some of the rate cuts. I think there's personally a risk that in March, when we get the new dot plots, because we get dot plots every quarter,
Correct.
I think when we get the dot plots in March, they actually might be more hawkish than what they were in December. And the reason I say that is because, every year we have four regional federal governors roll off and four more come on. And if you look at the people that rolled off, people like Austin Goolsbee in Chicago, and the people that rolled on, like Waller and Bostic, et cetera. We have more hawkish governors moving on and more dovish governors moving off. And so, if anything, I think there's a risk um, that I'm not saying it's a huge risk, but I think if anything, there's a risk that these dots move higher, not lower. And so the market's caught up to the Fed, but could the Fed even move? And so I think this inflation is something that's really stuck there. And this topic comes up a lot, Tony, where people say, "Well, is the Fed independent or not? Is the Fed worried about politics, et cetera?" Um, I think the Fed takes great pains to show that they're not being affected by politics, but I think they are affected by ego. And I think Jay Powell and his ego does not want to be the last central banker who had inflation on his watch. And that, the last one before that was Arthur Burns, who's generally thought of as the worst central banker in history. And I don't think Jay Powell, from an ego standpoint, wants to go down as the worst central banker in history. I don't think any one of us would. I'm not going to pick on Jay Powell. I don't think anyone wants to go down as the worst in history. And so I look at that and I think that the Fed personally is going to be probably more patient than most people think. And so I think higher for longer is still the case. And I'm not so sure that the market's pricing that in.
Yeah, Richard, I really agree with you on all of this, especially when you actually talk about the few things that market expectation over the rate cut compared to the Federal Reserve's like guidance show as the Fed dot plot. And 2 weeks ago, when we actually have a previous section, we also commented on about this. We commented that market always projected something unrealistic to certain point that Federal Reserve is going to take a more of a dovish step compared to the reality, right? Even since the beginning of the last year. Now, with the release of the CPI data, which actually showed that increase of 0.3% in January on a seasonal adjust basis, just compare the 0.2% increase in December. So the market actually interpreted this with very negative things and suddenly dropped. But the second day, 1 day later, they actually started to realize that they pricing, they started to get slightly deeper. They find out what had been really pointed into the CPI is mainly or was mainly one of the, I think, the rental costs, the rental expense increased very significantly in
Yeah.
general. I think that's one of the major components that actually hold the surprise or upside surprise for the CPI data. But if we actually slightly analyze more about that, the rental costs, it actually turned out to be, it may not be really sustainable. What most of the time we know that over the past 12 months, the real estate price or the average real estate price across the US has increased very stubbornly, okay, especially in a coast area, including also Florida. Now, that turned out to be have been factored into how much the rent that the homeowner wanted to charge compared to the reality. And it turned out to be they actually really want to charge slightly higher than the market rate. That's why when they actually convert factor into the CPI, because what the rental cost they did, the way that they collected is one section they actually collect through the survey from the homeowner. So homeowners really think that this is might be the high price, like owner rental equivalent, or
Yeah, owner's equivalent rent it. Yeah. Yep.
yeah, owner equivalent rent. Yes, thank you. So that actually is slightly higher than reality. I think in that case, if we actually started getting into February, March, that portion I think might slightly come down, because we do have seen the rent started coming down. So from that point of view, that's like might not be sustainable. That might be uh explain explain that what happened in the second day after the CPI data release, that the market actually rebounds heavily, because they price in that even though Federal Reserve might not cut the interest rate in March and May, but they will actually come back to cut it in June and in early 2025. Because this year is presidential election year, so no one actually want to be a bad guy, right? This is in this presidential election year, there might not be too many windows allowed for Federal Reserve to take action. May, as what we discussed last time, May, June, September.
Yeah, maybe
Yeah,
September. I don't know. I think September almost is too close to the election
yeah,
that they
too
may
close
not
to the
want to do
election.
it.
So
So
September, so not many windows actually
yeah,
available. So that's when you actually go in. If we rule out the March, then
yeah.
only three times it is possible that Federal Reserve can take action. That's why right now market really uh factor in roughly three times might be the best that we can get 25 basis point each for the rest of the year. This is, I think, then, but they're going to take an accelerated approach right after the election, because no one want to step into the middle of election and then be blamed for whatever the outcome, no matter what outcome coming up, right? So this is might be the issue. So from that point of view, high for longer, especially in this year, 2024, will be the most likely outcome as well. So this is the part that I highly agree with you.
Yeah, I would I totally know what you're saying with the housing. We saw that housing was a big driver of the reason CPI was higher than expected, and the market shrugged that off because everyone wants to look at what Redfin or Zillow are saying their houses or rent is worth, and they calculate an owner's equivalent rent based on that, and then they say that the owner's equivalent rent for the CPI should come lower. Um,
Yes.
and that has dislocated of late. It hasn't necessarily been as good a predictor as people say. I will tell you anecdotally, I'm pretty active in the housing market here in Chicago as both as a landlord and purchaser of houses, et cetera. The market is still pretty hot and pretty crazy. There's
Yeah, very hot,
no
very hot.
supply. Anything that comes on the market, there's a bidding war for. Any good apartment that comes on the market, there's a bidding war for. So I guess maybe that's I'm scarred a little bit by my own personal experiences. And it's not like Chicago is a hot housing market, right? Now, most people are
Correct,
trying to leave
correct.
Illinois. And so I still think that there's a bit of heat in the housing. But I think importantly, even if we forget about that housing, if we go back to what Jay Powell told us he cares about, he said
Mhm.
he cares about the core, so X food and energy,
Yes.
and he core X housing services employment or services inflation. That's what he cares about. And if you look at that number, the X food and energy, X housing, services inflation, that was much higher than expected this month, and it's nowhere near the 2% target that they're looking for. And so I think just simply looking at that, forgetting about the housing, forgetting about all these other drivers, that's still too high, and we see that we know that we see that with look at all these wage gains that we saw the unions get last summer are, making their way into prices. If you look at small businesses which are not doing particularly well and seeing their sales fall, they are still raising prices because small businesses largely outsource everything, and we're seeing this reflected in shipping, in rails, in freight, in the last mile delivery. Every element of getting a product into a store, getting a product to a home has gone up in price, and so that stickiness is certainly, I think, leading to higher prices. And I think it's going to lead to higher rates. I think the only thing that's going to ultimately bail out the Fed in terms of inflation would be if we do have a hard landing, which, as we've talked about before, no one is pricing in a hard landing at this point. Everyone's expecting some sort of soft landing, but perhaps that would be the one thing. And the Fed has talked about potentially needing to cause a recession to bring inflation lower, and that it's looking more and more like that might have to be the case. And this idea of a soft landing isn't really going to play out. One thing I also wanted to look at along those lines of whether or not we'll have a hard landing or soft landing, is this notion of the yield curve, right? But before I
Right.
get to that, Tony, I wanted to show you one other chart along those lines of whether rates matter or not. I don't. Hopefully, you can see this here. Um, and I'm looking, what this is the white line is the 2-year Treasury yield. It's inverted, but it's
Right.
the 2-year Treasury yield. And what we can see here is over the last 6 months, we can see that rally in the markets in the last 3 months of 4 months of the year, or less, from November, December, January. The rally was being driven by 2-year yields moving from 5.2% to 4.2%, right?
Mhm.
And that was rate cuts being priced into the market.
Mhm.
And that drove the blue line is the S&P 500 forward PE, and that drove the PE higher, right? As the cost of capital is coming lower,
Correct.
investors are paying a higher multiple for earnings, and that is what drove the market higher. The orange line here is the S&P 500, and so that all makes sense. As rate cuts are getting priced in, multiples expand. Earnings were not really growing. Earnings were kind of flat to maybe up small, and so the rally was driven entirely by rate cut expectations and the multiple expansion. Now, what if we look at over the last couple of weeks, what has happened is that the 2-year yield has gone from 4.2% to 4.65%. And it looks like it wants to continue to head higher. The multiples have not corrected yet. The stock market hasn't really corrected yet. And so that's something where I think where even though the bond market is starting to has reassessed whether or not we're going to get rate cuts, I don't think the equity market has done that yet, and that's something to think about. And and that's the good scenario, right? That's the soft landing, but no rate cuts. That's still a positive scenario. A negative scenario would be what if happens if we do get rate cuts, but they come because we have a hard landing, and that's where I think a lot of people want to look at the yield curve, and this is the yield curve that most people think about is the 2-year 10-year part of the yield curve. If I looked at the 1-year 10-year, look exactly the same, but we're still inverted. We've been inverted now since May of last year, right? So we're going on
Correct.
10
Long
months of
time. Yeah.
inversion, and the yield curve has, as we look back at the red shaded areas on here, the yield curve has been a perfect predictor of recession. When we've inverted, we've had a recession. Now the problem with it, as we've talked about, is that sometimes it happens in 6 months, as we saw back around COVID, and sometimes it takes 2 years, as we saw back in the mid 90s, as we saw even around the yield curve first inverted in 2006 before we had the recession in 2008. And so there's nothing that says it has to happen this year, but we are about you're going on about a year into yield curve inversion, and so we should expect some difficult times ahead. And the yield curve inversion is really just telling us that bank margins are getting squeezed, and there's less incentive for lenders of capital to be lending out, and so it's going to make it harder for businesses to get growth capital in order to invest in their businesses. And that's usually what the yield curve is telling us. Now, what we do see is that when the yield curve re-steepens back above zero, that's almost always like recession is going to happen almost imminently, right? Every time we've seen that was when the yield curve has re-steepened. We started to see, we're starting to see that at this point. We're not quite there yet, but that's something where I think we want to be aware of that. And then the other thing I would show you, and I'll pass it off to you, is another version of the yield curve. And this is what Jay Powell has told us. He told us this almost 18 months ago, that what the Fed looks at is the difference between the sixth contract of the euro dollars and the first contract of the euro dollars. Now I know euro dollars is going away, et cetera. And so we have to replace this with SOFR. But this is what I was looking at as of June of last year when they kind of went away. Um, is that, you know, when we look at this measure here, anytime it's gotten below zero, we've had a recession, and that's again when it's inverted, we've had a recession, and we are got to in June of last year, we got to -2%, and so we got very, if you look at it over the last 50 years, we've never gotten that inverted, and so that's another one that's telling you that we potentially could be having this yield curve inversion is potentially telling us that we might be having a recession on the horizon. Again, I don't think anyone's talking about a hard landing or recession at this point, but there are still some data points out there that suggest that we could get a hard landing, which would be good for inflation, and it might mean rate cuts, but I don't know if that would be necessarily so great for the stock market. What do you think about that?
Yeah, Rich, you cover so many great points out there. Maybe I should try to add some comments right from the beginning, like especially about what the one of the indicators that you point the Federal Reserve really look at the CPI, especially core of the cores, excluding the energy, food, uh, and gasoline. Now, what we have seen over the past couple of days, past couple of months, the the wage pressure is actually the driver for the service cost increase, which actually become one of the major components within the CPI, right? We continue to see the service index continue to go high. This is simply because a couple of things. One is the high demand from the consumer. The consumer have a high demand for the service, including the healthcare service, including the restaurant or the food delivery service and taxi, etc. Now, over the past couple of weeks, just since the beginning of this year, we continue to see the layoff from the big tech corporation, right, including Amazon and including Accenture and even including the UPS at this moment. UPS, remember last year we talked about the union was successfully being able to negotiate the pay raise for the next couple of years to actually raise to an average salary about 175,000 per driver. Now that's actually gave a lot of pressures for the demand because since the wage continue to go high and because of this kind of the demand for this kind of service, we can imagine the inflation, especially this part of component, the service index will continue to go higher. If we actually eliminated another factor, major factor from a CPI, the commodity factor, the commodity price continued to go down, including the maybe some traditional commodity that we have, like copper, aluminum. This is continue to go down. So this actually would help the decrease of the CPI, which would, I believe, will continue to be the case. The service index reflected within the wage hike pressure it seemed to me is going down. So one of the unproved tactic, this is something that a lot of people has talked about, especially those big firms, when they actually start to lay off the people, might quickly they might quickly actually repost the same position with the same functionality, but with roughly about 15 or 20% pay cut. This actually, whether it's widespread tactic or not, it actually is telling us that from the employer perspective, they don't see the demand to really continue to hike the salary to actually to recruit the talent people. If that's the case, right, that they would not be able to do that because in the past couple of years, when the demand for the machine learning for the AI surged dramatically, they actually would hike the salary, especially for this kind of software engineer, software developer, which actually the salary and total compensation hike significantly, way more than the average of all of the job category across the U.S. Now, if we saw that kind of pressure decrease, that's might actually telling us from employer perspective, they don't see the imminent pressure for the wage hike to attract the talent, especially we look at the East Coast. Similarly, in the financial center, East Coast, they will continue to see like Citibank will actually restructure their business with roughly about more than 20,000 people impacted. So in that case, the service costs might actually start to come down gradually across the year, but with the economy remaining so strong as what you point out, even though we started to see the inverted yield curve spread, but it hasn't really broken even. That's telling us one of the major driver apparently is that the U.S. economy is becoming so resilient, so strong. I think last year is the one word to describe U.S. economy is resilience, and this might be exactly the same case again in this year, given what had happened outside of the US. If we look at economy in Europe, economy in Japan, China, and India, apparently China continued to suffer in its due to like the weakening or weakened domestic demand and simultaneously like a weakened demand from the rest of the world for the Chinese product. No, the Chinese economies suffer. That's actually would, to a certain extent, would help the decrease of the commodity price because China used to be one of the largest manufacturer in the world. Which now with that Chinese economy, like we now seen even a turning around or being stable. So we might not see too much of pressure over the commodity price. So with the wage high, even though still positive, but declining, we'll expect maybe the service index will remain stable. That actually would help this coming down of the CPI. But the CPI it's actually incremental data, but from the consumer perspective, just like you and me going to the grocery store, it's what really matters. It's the price, right? It's the absolute price, not about the
Yeah,
incremental. The
totally
price,
agree. Yeah.
yeah, the price that consumer are paying still remain very high. If we actually go to Costco, that we can see maybe some kind of a steak or red buy or just a small package used to be maybe $25 per package. Now it's a 40 or even 50. It can easily go to 770 or 80, right? So
Yeah.
from the consumers like feeling touch, they actually feel the price will be very high. So at this maybe gradually will change the habit of buying and purchasing. I think this is what's happening. So to a certain extent, this is my reflect to what people can talk about. This is called not the inflation, but maybe called shrinkflation to a certain extent. It's actually we see the price continue to remain high, but simultaneously the consumer they might purchase, but they might actually purchase less than what they intended to purchase. So this is will gradually factor into the CPI. Now coming back to the market that you actually talked about, which actually turned out to be very interesting. So market really hasn't really priced in as what you have suggested over the past couple of weeks. Even the shortened yield curve increased, but market actually continued to go to historical high because of the ongoing tech rally. But the tech rally this year is slightly different what the tech rally last year. The tech rally last year was mainly driven by the Magnificent Seven. But now this year, what we have seen is the Apple and Tesla was or are out of the game, right? It mainly just driven by the few of the company, especially Nvidia, Meta, Google, Amazon, right? So it actually, I also make a term. I think that the term that people started talk, it's converted from Magnificent Seven to Mana, the Mana Four. Or some people would try to actually including another company called the Tax Taiwan Semiconductor (TSM) into what they call the AI5. But if we actually take Taiwan Semiconductor out of this, it's like what's really becoming mana. So Tesla and Apple turn out to be some of the jagger for the tech within this tech rally. Whereas this continues like a high for longer rate policy, the large cap growth sector will still be a favorable one, in my opinion for the rest of the year, given right now the Federal Reserve might not have too many windows as what we discussed to actually read to cut rate. So I think that's what had been the main driver behind the market movement over the past couple of weeks since the beginning of this year. Now, China apparently, this is what we discussed in the last episode, will only start to see its stock market rebounding right before the Chinese New Year, just 2 weeks ago. Just we start to see maybe stabilizing, but whether it's going to make a turn, this is something that we don't know. And apparently, as this second largest economy in the world, without the Chinese really rebounding, that probably most of the capital will still continue to flow from the emerging market to the developer market, especially into the US. Yeah, this is what my take was, just reflection on what you just actually talked about. You cover many great points over there.
Yeah, no, you're absolutely right, and we're definitely seeing a narrowing, not broadening, right? I think one of the things that got me and others excited at the end of the year was not just that market was rallying, but more stocks are getting carried along, and maybe that Magnificent Seven rally was broadening out into something else. But I think you hit it on the head, Tony, that it's actually quite the opposite this year, right? It's not only is the rally not broadening, we see small caps are actually lower on the year.
Yeah,
We're seeing that Magnificent Seven has been cut to 4 or 5 names, and so
correct.
it's fewer and fewer names taking us higher, and that's where I think I've seen probably more references to how this compares to the tech just in the last month or so than I did all of last year. They've of course always been there, but that the fact that there's a narrowing of leadership. And the fact that it's really just the U.S. market for the most part, right? Because you mentioned the Chinese stock market, it's got a nice bounce into Chinese New Year.
Yes,
But that's seasonal. We see that all the time. Um,
correct.
we've also seen data that Japan's gone into a recession, Germany's gone into a recession, UK's in a
UK,
recession. We know China's economy has been struggling. Um, yes, India is doing well, as we've talked about India several times, but
yes.
the U.S. and India are probably the only two players right now where we're seeing solid economic data, and I think that's one of the things that is holding down a lot of the commodity prices, as you talked about, and so but is that giving us a false sense of security?
Mm-hmm.
Because S&P earnings are ultimately multinational, and we
Correct.
we are in a world where the geopolitics are a little bit more dangerous. But again, along those lines of that late '90s, the late '90s comparison, Nvidia. I mean, no doubt about it. Nvidia is the best name to play, right? It's the whole picks and shovels argument. They are the one place you can go for chips, etc. But the current price to sales at 40 times price to sales, 30 times 2024 expectation for price to sales, 19 times 2025 expectation for price to sales. These are price to sales, not price to earnings, price to sales. This definitely has echoes of Cisco Systems and Sun Microsystems and those names in the late 90s, when I think after the fact we looked at it and said, you know, and you look at it, I look at a name like Cisco in particular, and that was the only name you wanted to play in the internet, and the internet was going to change the world, and the internet did change the world, and Cisco was the only name you wanted to play. It's just everything. The story played out exactly the way everyone said it was going to play out, and yet Cisco has still never gotten back to the high levels it achieved in 1999, 2000. I'm not saying that that's going to happen to Nvidia, but I definitely see that a lot of that expectations and forward growth is being pulled into the current stock price. We'll see this week, right? We get some earnings from Nvidia this week, so that will certainly give us some sort of sense. I'm sure they'll be fine. But that to me is when I look at that, I'm like, okay, there's some signs of that. But I think more importantly, and this is kind of maybe the last thing we want to cover here, Tony, is the factors and styles of what's driving the market. And I mean, no, that's right in your sweet spot. But I look at it, and this is another topic of conversation that I've seen a lot of narratives is about the momentum factor and how the influence of passive money and how passive money has now started to dominate active money. Um, and how momentum has become a much more prominent factor, and how um, money flowing in doesn't care about price. It just buys the biggest names, and it continues to buy those biggest names as long as money flows in. And we see that at the first of the month and the middle of the month, right? We see that with the 401k and IRA money coming in because we know that it goes in the 401k at paycheck time, and every time at paycheck time we see money come into the passive funds, and we see a bump in those stocks at the first and the 15th of the month. Um, and so, that, and at the same time, we know what the problem with too much passive is that as money comes in, price goes up. But what happens if all of a sudden money starts coming out and you say to yourself, well, why would money ever come out of passive? Well, because we've got retiring baby boomers who, by the time they reach the age of 70 or 72, are by law have to take money out of their 401ks and out of their IRAs. And so
Mhm.
that we're starting to hit that inflection point where we might start seeing money coming out of these passive vehicles. And what does that mean for the market? But momentum is definitely been the leading style. Momentum, large cap, and growth has been driving it. But I've got the Bloomberg factors here. Maybe I'll share the Bloomberg factors
Sure.
of what's working in the market. Tony, you tell me how you're looking at the world in terms of
Okay.
factors and styles. Hopefully you can see here, and I've got this is on a sector neutral basis. What's
Yes.
what's been working? Momentum, multi-factor, market capitalization, growth, earnings revisions. You can see are all up there, and then quality and dividends are at the low. They're at the bottom. People don't want quality; they don't want dividends.
Correct.
They
Correct.
want everything else. But what do you think about this?
Yeah, exactly, Rich. This is a fantastic comment that you actually just talk about. Now, if we actually look at year to date, the factor performance from what we have seen from the Bloomberg, the year to date, yeah, the highs apparently, if we just look at the highs, it's basically one is the momentum. This is definitely no doubt. And when talking about momentum, we know the reason for momentum to factor to really play out in the market is when the sentiment for the investor, among investor, for both institutional investor and retail investor has actually reached to above average point. So if we actually refer to the CNN Fear and Greed Index, this is a very general index that investor can actually look at. That right now is showing the right now it's actually at extreme greed phase. Whenever it's extreme greed phase, which we can actually saw what had happened over the past couple of weeks, even the past 2 weeks since we discussed in the last episode. We continue to see some uh, risky assets rally significantly. For instance, like Bitcoin and crypto assets, no doubt, right? We correctly pointed out the sell on news schema. Then after that, after consolidation for 2 weeks, then it actually pop up and come back up. Now the other in the AI hype is another scenario. Within the AI hype, one company like SMIC, the super micro company. So this is a chip company. This is actually company has rallied almost a double within a 2 to 3 week time period. Now that's from typically was driven mainly by the small institution like hedge fund and retail investor, then actually continue to pump up the price. Yeah, SMIC. This is something that what we can uh
I think I maybe
as
I
semiconductor.
I'll look it up while you're talking. Go
Yeah,
ahead.
okay. So
SMCI.
here,
I think I
SMCI, sorry, yeah, SMCI, sorry. Now here, what we can actually see, this is all are telling us the sentiment has reached into a greed phase from investors, for both retail investor and institutional investor, this is a huge, big alarm for all of us that market might actually has reached to a reflection point. So last Friday, just by before market close, we saw 20% down for this stock. Now this is all telling me from retail investor that we should be vigilant, stay vigilant. Now from the institutional point of view, another big news also give me some kind of a concern that the Harvard endowment actually has already sold off most of their holding within the healthcare company and only focus on the mana stock that we just talked about. You know what? We went for a university endowment, which tend to be should be for long term and actually can be should be not risk taking, but rather than risk averse institution. Now also focus the investment into this kind of mana stock. This is actually made me think quite close to what you pointed out, the 1990 time period. But what people continue to argue the difference between now and in the past, 1990, late 1990, is now because those mana, the major large tech company, continue to generate the strong and huge cash flow, positive cash flow, versus back to 1990, late 1990, those many companies just coming up with a concept. They just say, hey, we want to build a website or we want to build a internet company just to provide certain kind of service that a lot of capital would just throw in with now even some operation. So people argue that this time might be different. Now, to a certain degree that I tend to agree this might be the case. However, for some very risky asset, just like SMCI, the one we talked about, or some crypto asset with long duration, we continue to uh, uh, alert investors, especially the audience for the macro matters. Like this actually pose significant risks that when we actually do some asset allocation, this is really should consider about the weight and some risk aspect embedded within the certain asset classes. I think will be extremely interesting. Apparently next week, NVIDIA is going to report the earnings. We have no doubt that NVIDIA is going to beat both top and bottom line. Might not be the question. The question really lies ahead, like what might be the rest of the year might look like. Even the people can think the rest of the year could continue to be good. However, the lead time for the NVIDIA's GPU has decreased from I think 8 to 10 months a couple of weeks ago to now. I think is much less than that long time waiting. So this actually would show me that the sentiment could change dramatically, and we actually reach to the extremely greed status. This is give a lot of red flags right over there, Rich. This is
Yeah, no, you're right, and I mean, and you're right. These mana companies do have earnings and they do have cash flow, which is quite different than the late 1990s. However, Nvidia is trading at 100 times price to free cash flow, and Microsoft's
yes,
trading at 45 times price to free cash flow,
all right,
and so there's cash flow there, but they're still trading at pretty high prices, and so
right,
I think the other
certainly,
thing I think
no
just
problem.
from
Yes,
trying to draw the risks of it, I know is with Supermicro and Nvidia is the idea that many of these companies might be using vendor financing where they're essentially lending money to their customers to buy their chips, and so that also has echoes of the late 90s. But we'll see. I mean, well, like you said, we'll get earnings this week from Nvidia, and we'll see. They'll probably be very good, but will they be good enough? Well,
all
that's
right,
something that we'll have to see.
yeah, whether
And I
we good
definitely,
enough.
yeah, we definitely see people crowding into a few names, and that is always a sign of concern. But that said, investors are still want to stay involved and invest in this market, and the economy continues to chug along. And that tells me that financial conditions stay easy and the wealth effect remains very, very real. And that tells us, going wrapping it all full circle, that the Fed is probably not going to be cutting rates anytime soon.
Correct. This is exactly what's going to happen. I think Federal Reserve is not going to step in to have any interference over the presidential election and from any circumstance. So here, the market might be at a very high, very emotional stage, sentimental or greed status. So this is a huge concern for most, should be a huge concern for most of the investors at this moment, paying attention to the risk or unilateral or unjustified risks that have been taken within some risky assets.
Absolutely. Well, Tony, with that, I think we'll wrap it up here on this President's Day edition of the Macro Matters. We covered the full gamut from Fed policy
Yes.
to Nvidia earnings and back. And so, always good to have you. Always good to talk. And look forward to talking to you in a couple more weeks.
Yeah, definitely. Well, definitely after many companies that are reporting the earnings in the next 2 weeks, we will come back and actually have a more of sharing, I think, and more comments on that.
Sounds good. Thanks everyone for listening to Macro Matters, and always as like, share, and subscribe if you like what we're talking about, and make sure that you can get this out to as many people as possible. Have a good holiday.
Yeah, have a good holiday. Thank you.